Students, today we are going to learn financial management. In financial management, we have one important concept called dividend policy. In dividend policy, there are three models, namely Walter model, Gordon model, and model. Today, we are going to learn Walter model. Under Walter model, we are going to learn market value of equity share. At the same time, in Walter model, there are three categories. One is the problem in relation to the growth firm. Another one is the problem in relation to the normal firm. Another one is the problem in relation to the declining firm. In this problem, we are going to learn about market value of share of growth firm. What is growth firm? In growth firm, the rate of return is more than cost of capital. What is rate of return? Return on investment. Return on investment is more than the cost of capital. Okay, let me see the problem. Sum number 1. The cost of capital and rate of return on investment of Rafael Limited are 10% and 18%. So the cost of capital is 10%, rate of return on investment is 18%. Respectively, the company has 5 lakh equity shares of rupees 10 each. So number of equity shares are 5 lakh. Earning per share are rupees 20. Compute market value of equity share under Walter model. Situation 1, no retention. No retention. There is no retention ratio. 100% paid to the shareholder. So, if no retention, the payout ratio is 100%. In situation 2, 40% retaining, 60% payout. In third situation, 80% retention, 20% payout. In fourth situation, we have 100% retention, 0% payout. First, we are going to solve no retention. No retention means no retention, which means 100% payout. So payout ratio is 100%. Now we are going to learn the market value of equity share under Walter model in relation to the growth firm. So market value of equity share. Market value of equity share. Formula is D. D means dividend plus R divided by K. R means rate of return. K means cost of capital. Open the bracket. E minus D. E means earning per share. D means already we know dividend. Divided by K, cost of capital. I am writing one by one. D, which means dividend per share. Dividend per share. R. R means rate of return. We can say rate of return, return on investment, or internal rate of return. Next, K, which means cost of capital. Cost of capital or capitalization rate. Then E. E means earning per share. Now we are going to calculate D. Dividend per share. So dividend is not given in the question. For that the formula is EPS multiplied by payout ratio. EPS multiplied by payout ratio. EPS given in the question. Where is the earning per share? How much? 20 rupees. The payout ratio is 100%. So payout ratio is 100%. So total EPS paid to the shareholder as dividend. Then rate of return. Cost of capital and rate of return. Cost of capital 10%. We can write it as 0.10. Rate of return 18%. We can write it as 0.18. Then earning per share, it is given in the question. That is rupees 20. Now we can apply the formula. D, just now we ascertained 20 plus R given in the question 0.18 divided by K 0.10, open the bracket, earning per share 20 minus dividend per share also 20 divided by K. K how much? 0.10. Now we can complete this. First we should divide 0.18 divided by 10. So 0.18 divided by 0.1 will get 1.8. 1.8, then we should subtract 20 from 20. We will get how much? 0. So 1.8 multiplied by 0 will get how much? 0. So 20 plus 0, 20. The denominator remains same. So 20 divided by 0.10. So market value of equity share rupees 200. So per equity share, when payout is 100%, the market value of equity share rupees 200. Then we found market value of per equity share. Now we can find market value of share overall. Market value of equity share. Market value of equity share overall. For the total number of equity shares, total number of equity shares multiplied by each share market value. Each equity share market value. Total number of equity share given in the question, value 5 lakh. 5 lakh. Each equity share value, market value 200. So the market value of overall equity share 5 lakh into 200. So the value 100000000. So the market value of overall equity share is 1, 10, 100, 1000, 10,000, lakh, 10 lakh, crore, 10 crore. So the overall value of equity share is 10 crore when payout ratio is 100%. Now we completed situation 1. Now we'll move to the situation 2. Students, now we'll go to situation 2. Situation 2, 40% retention, which means 60% payout. Yes. Situation 2, 40% retention, 60% payout. Market value of equity share, formula D plus R by K, open the bracket, E minus D divided by K. Same formula. First we have to find D, dividend per share. The formula is EPS into payout. EPS we know 20 into payout ratio how much? 60%. So our dividend 12 rupees. So now we can apply the formula. So D 12, R 0.18 divided by K 0.10, open the bracket, EPS 20, dividend per share 12 divided by K 0.10. Now we will start from 0.18. Yes, 0.18 divided by 0.10. So 0.18 divided by 0.10. So if we divide, we will get 1.8. 1.8 multiplied by 8. 1.8 multiplied by 8. We got 8 by subtracting 12 from 20. So 8 into 1.8. We'll get 14.4 plus the dividend as usual 12 divided by 0.10. So total 26.4 divided by 0.10. So plus 12. So 26.4 divided by 0.10 will get rupees 264. So market value of equity share per equity share is 264. Total number of equity shares we know 5 lakh. Each equity share value 264. So 5 lakh multiplied by 264 will get 1320 00 000. So when payout ratio is 60%, market value of per equity share is 264. Students, we completed second situation. Now we'll move to the third situation. Students, now we'll move to the third situation. Look at the board. In third situation, retention ratio is 80%, payout ratio is 20%. Yes, I'm going to apply the same formula. We have to change the payout ratio. So dividend per share, EPS multiplied by payout. EPS we know 20 per share multiplied by payout is 20%. So 20 into 4%, 20 into 20%, 20 multiplied by 20%, we get how much? 4. Now we can apply the formula. D we know 4 plus 0.18 divided by 0.10, open the bracket, EPS minus dividend per share divided by cost of capital. What we have to do? First we should divide R and K. So for that answer is 1.8. 20 minus 4, 16. So first we should multiply 1.8 into 16. So we'll get 28.8 plus 4 divided by 0.10. So total 28.8 plus 4, 32.8 divided by 0.10. So 32.8 divided by 0.10 will get 328 per equity share. So the total value of total market value of equity share as a whole 5 lakh multiplied by 328. So 5 lakh multiplied by 328. So the answer is 1640 00 000. Students, we completed third situation. Now we'll go to the fourth situation. Students, now we'll move to fourth situation. Fourth situation, 100% retention, no dividend is paid. So the payout ratio is 0. So situation number 4. Market value of equity share, same formula. We have to find the dividend only. EPS, we know 20 per share. Payout ratio is 0%. So dividend value is 0. So now we'll apply. Dividend is 0 plus R which is 0.18 divided by 0.10. Here earning per share 20, E 20, dividend 0 divided by K is 10%, that is 0.10. So 0.18 divided by 0.1 will get 1.8. 20 minus 0, 20. First we have to multiply 20 with 1.8. So 20 multiplied by 1.8. So value 36 plus D value 0 divided by 0.10. So 36 divided by 0.10. 36 divided by 0.10 will get 360 per share. So total value of equity share, total number of equity share 5 lakh multiplied by 360. So 360 multiplied by 5 lakh, our value is 1800 and 000. So when the retention ratio is 80%, the market value of per equity share 328. When the retention is 100%, that is a zero payout ratio, the market value of per equity share rupees 360. Students, already I said we are learning Walter model growth firm. Growth firm means the rate of return more than cost of capital. Rate of return we know 18%. Cost of capital is 10%. So when rate of return exceeds the cost of capital, which means the return on investment more than the cost of capital, which is growth form. In growth form, what happens when payout decreases? When payout decreases, the value of the equity share, per equity share, what happened? Increases. So analysis, Rafael Limited is a growth firm. Rafael Limited is a growth firm, which is R more than K. Here, when payout ratio decreases, the market value of per equity share increases. So what happened? Payout ratio decreases, the market value of per equity share increases, which means optimum payout ratio for growth firm is 0%. See here, when payout is 0, the share price is more. Okay, students, today we learned how to calculate the value of equity share under Walter model in relation to the growth firm. In next class, we'll solve one problem in relation to normal firm. Till then, bye and thank you.